Hi everyone, welcome to my video. I am Doris and I'm here to share with you about my stock account and the market updates today. So in the first 7 days of my stock account, my profit is $2,800 and that's a margin of 2.8%. The total value in my account is $102,800. Two US 10-year Treasury yields are framing the NASDAQ again. 3. The nightmare of Europeans is looming. So first we can see that today I earned a total of $3,365 and that's 338%. And here in the account I have position of SQQQ and DRV, and they both are bear ETF. The first one is the ETF for NASDAQ and the second one is for real estate. So for right now I have 1,300 shares of SQQQ and 500 shares of DRV, and I'm going to explain to you why I bought them today. So first let's take a look at the US 10-year yield. It rose 10 basis points to 3.852%. Here we can see in this chart that it rose to 3.852% today, and it's been continually rising since 10 a.m. this morning. Because inflation remains high and the Fed's interest rate hikes are expected to reach more than 4.5% in the future. Since it is the most sensitive to interest rates, the NASDAQ and the house prices will fall. Why I bought SQQQ and the DRV? Because as of real estate, it is most elastic to 10-year Treasury rate. So as for markets today in general, the Dow Jones rose 37.63 points or 0.11% to 33,241.56, and the NASDAQ lost 144.64 points or 1.38% to 10,353.23. The S&P 500 fell 15.57 points or 0.40% to 3,829.25. Here in the industry heat map, we can see that most of the technology stocks fell. This is because the rising US Treasury yield are weighing on the growth stocks, such as technology stocks. US economy. The market is still focusing on the possibility of a recession in the United States. Kingsley Crosby, Chief Global Strategist at LPL Financial, said, "What type of recession are we going to have?" This question remains unanswered. The answer to the question will largely depend on how much more the Fed needs to raise rates to address sticky inflation. Jose Torres, Senior Economist at Interactive Brokers, warned of a growing risk of the U.S. economy entering a stagflationary environment, where inflation remains high and economic and employment growth slows. Doris said the reason for the potential stagflation scenario is that the Fed has strengthened its hawkish monetary policy that began in March by raising interest rates and shrinking its balance sheet to curb the highest level of consumer price inflation in nearly 40 years. The most aggressive tightening cycle since the Volcker era in the 1980s. Europe economy. European Central Bank officials warned on Tuesday about a recession in Europe. The bank's vice president, Gendels, said on Tuesday that the outlook for the Eurozone economy has deteriorated and inflation was more persistent than expected. So further rate hikes are necessary until inflation is back on track, close to the 2% target. Given the current high level of uncertainty, we'll make decisions based on new data at each meeting. Our macroeconomic forecasts point to a brief mild recession in the Eurozone at the end of this year, Kendall said. However, we expect the economy to return to positive growth from the second quarter of 2023 and maintain this growth trend in 2024 and 2025. He noted that the ongoing energy crisis, rising uncertainty, a global economic slowdown, and tighter financing conditions are weighing on economic activity and have led to a significant slowdown in real GDP growth in the Eurozone in the third quarter of 2022. According to our calculations, we expect inflation to fall to its target of 2% in the second half of 2025. He said that the current economic situation in Europe is very serious, and the European economy will face two major tests in the coming years, namely digitalization and the transition to a greener and more sustainable economy, which will be the key to mitigating the effect of climate change. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.